Afternoon, everyone. Welcome to the Progress Macroeconomic Outlook. As many of you have attended this before, and for newcomers, welcome. If you have any questions throughout this presentation, please type them into the Q&A box that you can find at the bottom of your screen. We will get to them with the time remaining at the end of the conversation. With that, I'm going to send the mic over to Chris Legg, Senior Director of Progress Partners.
Thank you, Jessica. It's Chris Legg here. I'm a senior managing director at Progress Partners. With me in the podcast studio in the Seaport is Adrian Zermulin, managing partner at Progress Ventures, and Brett Chatfield, Vice President, Progress Ventures. As I said, we're trying a new format today. There's no video for our faces, but there's hopefully improved audio. We've gone into a improved studio. So with that, just a reminder, I think many of you know who we are and where we come from, but just as a refresh, Progress Partners is the investment bank. That's on the right here, and then Progress Ventures on the left. That's the early stage venture fund. They work very well together, very synergistically. Many of the EIRs, executive residents, are on this call. They've been incredibly helpful to our network. And our coverage area on the far outside, especially on the top and the right, continues to expand on the banking side. And in fact, previously we've been all B2B software. We recently hired Jamie Lane, who is doing consumer and health and wellness. So that's a new foray for us as we continue to expand. We're expanding on all sides, and we'll give you an update on that in a second. But if you see something, say something. I.e., if you think there's a deal out there and you want us to take a look at it, bring it to anybody you know at Progress, and we'd love to take a look. Just a quick second on the banking side, we'll be giving a much more broad overview of what we're seeing in the industry. We had a strong Q3 after, I'd say, a weaker start to the year. And you can really see the theme that the three deals we did in Q3 of this year are sort of the top three there on the top and the left. We're all sort of bought by someone with a financial sponsor in the background. So CM Equity, Bridgepoint in the UK, and then Carlyle here in the US were the ultimate sort of financial sponsors behind the acquirer. And that was a theme we've seen consistently for the last 2 years. As I said, a good Q3 after a sort of a softer start to the year, and we're seeing a reasonably robust Q4. On the venture side, we are a sector-focused fund, primarily B2B software, following these themes you see on the left side. We're really excited about the portfolio. Those are the logos you see in the middle. We think we followed those themes quite well, and we're quite excited by them. And looking forward to Fund 5 in 2025.
Yeah, and then just as a reminder, we are focused on the advertising, marketing, and media tech space. We're a specialist. We're very focused on being hands-on and really working with our companies. That has worked really well during these last couple of years, which have not been a traditional smooth number of growth years. And so we look to continue that with our next fund, and we plan to expand into the commerce tech and retail tech, as that's where we are seeing the innovation heading in the near future.
So it's been 2 weeks since the election here in the US, 1,000 days since the start of Russia invading Ukraine. We're going to talk about both those things and everything in between. And so let's start the macro update. Yeah. Over to you, Adrian.
Here is the macro overview forecast slide we have been using this year for you. We kind of set out on the left how we thought the year would shape up. And on the right, kind of where we are today and expecting to end the year. It's been very consistent this year. We thought this year would be pretty good. I think that's essentially where we're heading. Nice GDP growth, 2.5–3%, inflation coming under control, unemployment coming back to sustainable levels, and then interest rates coming down. I will say interest rates came down slower and later than we had originally predicted, but that downward, the easing cycle has now begun, and we expect that to continue next year. And so we feel good about this year. Yeah, lots of things have happened, but in a sense, it's been very consistent with what we thought. Where we're going to end up at when we started at the beginning of the year. We're continuing to monitor these items on the bottom left. They have not changed, and they continue to be concerns. We think they are being worked and managed, and we'll comment more on that. And then on the right, what are the implications of it? I think the fundamentals, despite how many people may seem to feel, are strong. Our M&A markets are improving, and risk on investing has definitely returned, especially here in the last quarter. We've really started to see things move, both large publics, but also more importantly, from our perspective, some of the smaller companies, which are key to kind of unleashing liquidity in our part of the market. So we'll go into more detail on all of that, but yeah, this is where we are.
And we're going to go to the macro risks at the bottom left of this page at the end of this section, and there's certainly a lot to talk about as it relates to that. This is a page I like. I like anything that shows sort of a 20-year time horizon. This is U.S. GDP growth as sort of a proxy for the health of the economy. And what you see is it's been remarkably consistent over 20 years. There was two shocks. There was the great financial crisis in 08-09. You can see that. And then there was the COVID in 2020. And, but quickly thereafter, the economy recovered, and quickly thereafter, it stabilized in that 2 to 3% range. And that's what you see in the green. That's sort of a nice, not too hot, not too cold. You can see that, in the last decade, through two very different administrations, Obama and Trump, guess what? The GDP growth was remarkably in that 2 to 3% range. The last 3 years, it's felt volatile from sometimes week to week, quarter to quarter, and the graph down below is in fact that it's over a 5-year spectrum. It's quarterly GDP, and this time last year, Q3 of 23, we had 5% growth, and then Q4 was 3%, and Q1 of this year was 1%. That didn't feel good, but on an annualized basis, it's sort of like the market. Don't watch it much day to day. Look at over time, longer time frame. These numbers are consistently in sort of the mid 2s to high 2s in terms of annual GDP growth. We think that's going to continue. That's our base case for the next 3 to 5 years, and we'll talk about more of that later on. This is a page I really like. As Adrian often says, it's hard to have a recession when corporate earnings are growing so well. And you see it on the left side. Again, a sort of a nice 20-year spectrum of the S&P 500 earnings, and both historic and future continue to grow at a healthy pace. And then when you sort of dive in on the right side, this is the top 25 companies in the S&P. And you can just see, you expect, if you took my previous page of sort of, 2.5%, 3% GDP growth over a 10-year period, that's what this is on the right side, 2014 to 2024, you expect, maybe operating income to grow, even compounded, say 40, 50% over a 10-year period. It's grown threefold from 181 billion to 500 plus billion. That's the operating income of the top 25 companies. And the top 5 companies in that, which are all tech now, even 10 years ago, you had Exxon and Verizon in that group, have really increased their share of operating income, their efficiency, their size, their market cap. All used to be sort of $500 billion. They're now multi-trillion-dollar companies. And that is really a big part of, the growth.
Yeah, and in a way, there is a deeper message there, is that the growth we've seen over the last couple of years has been driven by these large tech companies. And the remainder of the top 20 and really the remainder of the S&P 500 has grown, but not anywhere near at the rates that we have seen these top 5 companies grow. And so we believe there's plenty more growth from the rest of the universe there to come, which is partly why we're also very encouraged about growth, going forward, assuming the overall economy remains stable. But plenty more opportunity there to keep going. And just another comment on the left-hand chart. The earnings growth, I think, has caught many people by surprise. And clearly it's revenue growth, but also what has been really strong over the last couple of years is the cost side. And that, these companies have been very proactive about reducing cost, improving margins, and that in combination with pretty good revenue growth has produced these exceptional earnings growth that we're seeing that is driving the market.
So on the previous page, I talked about the growth in those 5 companies, and if you add in Meta and Tesla, so you have Microsoft, NVIDIA, Amazon, Google, Apple, that's what they call the Magnificent Seven. That's the growth on the left side here. I'll call it purple or very dark blue. They have far outpaced the broader S&P 500 earnings growth for really the last 5-6 years, and that's why you saw tremendous growth in their stock price and everything Adrian just said. Going forward, which is sort of on the right side of that dotted line, you can see that growth from the Magnificent Seven is starting to mature. You can see that both on the left side and the bottom right, where the incredible growth we've seen in software, in tech companies, still strong, but it's not as strong as it was historically. And also that means there's room for the other companies. Think of the Russell 2000 and broader indexes in the S&P 500, the broader stocks, to catch up. You can see that even that's happened already in the last few months, where in fact the Magnificent Seven, after leading most indexes over the last umpteen years, has finally been off a bit, and the others have a chance to catch up.
Yes, and so turning from there to the consumer, the U.S. economy is heavily driven by the consumer. We hear a lot about the consumer not feeling great about where things stand, but if you look at some of the statistics, we continue to see a different perspective. Consumer debt has been increasing. People have been borrowing more, and hence spending more. But while they're doing that, they have been able to handle that increase in borrowing. And both on the lower left side here, you see what household debt is as a percentage of their income. And it's very surprising that we're just now recovering to where we were before COVID. People really just saved during COVID. They're now back to this, what we think is a very sustainable level. They're not stretched, it seems. Yes, delinquencies on credit cards are going up a bit, but again, they're still below traditional norms. So we feel good about the consumer and their ability to keep driving the economy. And certainly as rates now start coming down, this will only improve. And you can see that on the lower right, the consumer sentiment chart. We've been waiting for that to tick up. Consumer sentiment was very low. And now we are starting to see movement in that, be it inconsistent movement. And I think inflation, has continued to make people uncomfortable. Rates, declining rates, of course, are helping to offset that. And we expect, as the Fed will continue to lower rates, as things continue to further improve, this will keep going up. And so we overall, takeaway from this page is do not think the consumer is stretched, and things will slowly but consistently keep getting better.
So the top left is another graph I love. It's 20 years of sort of the federal funds rate and CPI as a proxy for inflation. And generally those things should roughly move in sync. And you can just see how far out of sync we were 3 years ago when inflation peaked at 8 or 9% in this country, higher over in Europe, and interest rates were basically zero. And that's that sort of 8% spread you see. They jacked rates up as quick as they could. But also we were saying at the time that we saw inflation coming down quite quickly, and it did. It sort of came down to that 3% level. Now, as we'll talk about in a second, Brett will give you some more commentary, it's actually coming down 2% and going lower. So what you have now is a nice position where Fed funds rate, let's call it 4.5%, is nicely sort of 2+ points over inflation. And that's a lot of room, even if inflation does come up a bit, for rates to continue to go down. Over to you, Brett.
Right. So where exactly are we at with inflation right now? Inflation clocked in at 2.6% on an annual basis in October. This was a bit higher than the 2.4% that we got in the September print, but trends are largely positive and moving in the right direction. We're quickly approaching the 2% target that the Fed typically sets as an ideal inflation rate. We're no longer anywhere close to the 8 or 9% that we saw in 2021 and 2022. And things are largely moving in the right direction. CPI can be broken into a few major categories. Firstly, you can break it into core and non-core. Core strips out volatile items like food and energy. And as you can see on the right, those are starting to quickly alleviate. If you look at some of the core items, you can bifurcate it into goods and services. Goods are not only slowing their rate of inflation at this point, but some of the major areas like commodities, new and used vehicles, they're actually getting cheaper. The last leg of inflation is within services. This is closely tied to the labor market, which is now becoming more balanced. A major driver within services is shelter. Everybody talks about how much this is kind of keeping up inflation at this point, but we're optimistic it'll come down, not only with decreasing rates, but also with the alleviation on supply that's going to come with a lot of these new multifamily housing units coming to market. One last point is down in the bottom right. We like to look at inflation net of shelter. So if you assume that shelter inflation is over a third, it's 36% of the CPI weighting, and your headline is 2.6%. Everything else is at 1.3 right now, which is well below the target and in line with where we'd like to see it.
Yeah, and maybe let me make one additional comment here. Earlier in this year, we were actually concerned that inflation would fall so quickly and closer to zero, if not negative. What we're seeing right now, we are less concerned about that, and probably believe that things will stay closer to the 2%. So we've shifted a little bit, but net, we really feel like inflation has come under control, and that the aberration of the last couple of years is behind us. Let me make a couple comments on the labor market. We focused a lot on this in the last couple times we did this. We really think the labor market is, despite the kind of the weak number in October, which we really think was distorted, is in a pretty good place. The shortages that we saw the last couple of years are starting to disappear, and you can see there on the right, job openings and the ratio of openings, everything is coming back into balance. I think mostly driven by people returning to the labor force, kind of adjusting in this post-COVID environment, and of course a lot of immigration, that people that have come in. So we think we're in a much better place. We will continue to watch this, particular as some of the policy changes that will likely come in starting with the new year, that this doesn't get away from us again, because again, this is a key driver to inflation. But right now, I think we're we think we're in a good place. Quick comment on commercial real estate. We spent a lot more time in the past here as well. People were very concerned that this would a systemic risk to the system. We have said all along that we didn't think so, because we think it was sufficiently spread out, and that things would come back. It has been a very difficult couple of years, or many years. Vacancies, especially in office space downtown, are still very high. We think we have turned the corner, particularly we watch it in Boston very closely. We think we see things getting better, more people on the streets, less vacancies coming down. So we more work to be done, but takeaway is it's not a systemic risk, and things are improving, and I think we're going to see more positive numbers going forward. And just as a quick reminder, on the upper right hand side is where is the loan exposure. Again, unlike the 2008 crisis, it's really sitting in many different places. So yes, things need to be adjusted and things need to be written down, but it's not going to bring down the financial system as we thought.
Yeah, two anecdotes I think really tell the story of an improving office market, which is I'm hearing more and more of tenants committing to new leases, and then 2 or 3 months later coming back and saying, we didn't commit to enough space because our business is growing, and or there's definitely a back to the office. If they were 3 days, they're going to 4 days. If they're 4 days, they're going to 5 days. So there's definitely an increase of people going back into the office and the policies of those companies that are employing those people.
Another different look that we haven't looked at in a while is the Fed balance sheet. And some of you may be less familiar or have looked less at this, but in addition to interest rates, the Fed can do a lot with its balance sheet. And that really started to become a key factor in 2008, with the great financial crisis, and then again with the start of COVID, where the Fed has been really injecting a lot of liquidity into the economy by buying illiquid assets from the holders of those assets and giving them cash that they can then loan out again. The Fed very consistently kept buying and building the balance sheet, as you can see there in 2021 and 2022, and has since then started to unwind that balance sheet, partly to having securities mature and also selling. And this, of course, counters, by letting its balance sheet shrink, right? It's effectively taking money out of the economy and so slowing things down. It has the same impact as increasing rates. So that has been going on, and you can still see that the Fed balance sheet is very elevated. I think the Fed would like to get this down further, but again, they're very mindful of that, especially as they're now lowering rates, not to counter that too much. This will be interesting to keep watch, because it remains a big factor. And of course, if we hit further turbulence down the road, I would expect them to use this tool again, and it has worked well in these last couple disruptions, and so we will keep watch of this more closely in our subsequent sessions. This, of course, is the interest rate out, the Fed funds rate, and we put it in a longer term perspective for you, just to kind of put a little bit more perspective on the cycle that we are in right now. Clearly, over the last 10 years, we've had these very unusual times of having almost 0% interest rates. We knew that was going to end. And then, of course, with the inflation coming in, the Fed hiked very significantly, very quickly. But if you look in the long-term trend, right, this was a quick hike, but it's not been an extreme hike. And now, of course, we're coming down. I don't expect us to come down to zero again. I think the Fed would like to get to around 3.5%. That gives them room to move up and room to move down if they need to. But I think overall, yes, inflation was bad these last couple of years, but I think they did a really nice job in really trying to crush it quickly without really having to go back to like what we saw in the 80s, where we had hyperinflation and really high interest rates. Again, we think they're going to try to work it down to around 3.5%. We'll see when they get there.
One small or strong tailwind that we believe we haven't seen material benefits of yet is the actual impact of AI. Both companies and investors have been investing billions of dollars into AI infrastructure and additional capabilities, which have largely at this point been just to test applications. We believe that a more mature application of AI is really yet to come, but is going to be a major driver of productivity in our labor force, and of course, therefore, a major contributor to GDP moving forward. If you look at the chart on the top left, this is a view of US labor productivity. What you'll see is that it was going up kind of into the time of the pandemic. A lot of that was driven by new technology changes. And since then, we've seen not only a dip, but a bit of a rebound. What that was from was actually not AI. That was actually more related to our labor force. People were switching jobs so quickly that they couldn't quite become too productive at them. Therefore, the productivity was going down. But now, as the labor market has rebalanced and people have stayed at jobs longer, you're beginning to see an increase in productivity. We believe that AI will most likely be the next leg in accelerating this, which is going to have a lot of positive impacts on the broader economy. To the right, you can see some of the spend that's gone into the space, not only on the VC front, but also within some of the large technology companies as well. These billions of dollars are going to go towards some new great waves of innovation that are going to continue to shape this. Lastly, down at the bottom, you see some of the survey results of how people would like to actually implement AI within their organizations, everything customer success to marketing to actually coding and doing other back office chores. It really is diverse in where it can be implemented. We've seen some pretty cool applications so far. One of the more famous ones in the tech world is with Klarna. They kind of revamped a lot of their customer success organization. AI now does the vast majority of their kind of easier to bucket problem tickets and allows humans to be more productive and focusing on those larger problems. So overall, we really see AI as a lift on what's going to be possible in the economy.
Yeah, just two more points to add. As Brett alluded to, this is in part of our thesis is this is really a seismic step function shift, much like sort of .com was 20 years ago, or to a lesser extent, as Adrian referred to, the operational improvements that came out of COVID from a new business environment. This will have a nice, sort of long-lasting, medium-term effect as part of our sort of 3 to 5 year bullish base case. And the other is just, again, Brett highlighted it, but on the far right, just how big these R&D budgets are for these large tech companies. It dwarfs the entire venture capital community. That's worth noting, and they're spending real time. So, and one of the first pages, we talked a little bit about some of the macro risks, and we said we'd highlight those a little later on. Here's the page. I'm going to spend a few minutes. It's an important page. And I would say, to date, these risks have been acceptable, I say, contained, maybe is too strong a word, but bracketed. But, even the next few months, it's going to be volatile. You can see it even today with Russia. They're jockeying. Israel's jockeying. China's jockeying. They're all sort of, moving the pieces on the chessboard around. But let me sort of dig down on this. So deglobalization is something we've talked about in previous presentations. It's only got some new life with the current president-elect. But to be fair, it's been a trend that's been going on for a while. Think back to Brexit in 2016. Think back to COVID, which changed our global supply chains. And even these wars we're going to talk about on the bottom, those last two have wreaked havoc on global supply chains. If you're Volkswagen making all your seatbelts in Ukraine, that has to change, and there's a whole bunch of disruptions and changes. Largely, though, the global economy has adjusted to these challenges on the bottom to date. Sovereign debt, we're going to talk about in the next couple of pages, and certainly energy and climate continues to be a risk, although I'd say more than that's just been adjustment for capital expenditures. But on the far left, certainly the recent election, how quick that happened. There was no contested election afterwards. That was a positive surprise, and that was part of the jump you saw in the market, that and other reasons. And certainly the Republicans controlling all three levels of government is beneficial in terms of just a clear mandate and a clear direction, although I think we're still finding out over the next couple of months what that direction is going to be. Government in this country, regardless of which side you're on, has been largely dysfunctional for an extended period of time. I don't think that's going to change. There's been some real challenges about how things get done, and that polarization will continue, and that fiscal discipline, which is a point that Adrian's going to address a little later on, is very real and really coming to bear. Next is on the Israeli conflict. That continues to augment. It's not contained neighboring countries, but generally the region has been acting rationally, and no one seems to want to escalate it too much. But that's something we're continuing to watch and continue to be concerned about. I mentioned earlier on, Russia, Ukraine, it's now 1,000 days. You've got North Korean soldiers in Ukraine. You've got the U.S. now allowing missiles into Russia. That continues to escalate. There's possibility with the new administration that may come to an end in 2025, but it can certainly be a challenge on a whole bunch of levels, human and economic. And then finally, China. The relationship there continues to deteriorate at some level. As I said in my opening comments, they are jockeying, but you can't underestimate the challenges they've had domestically. They have a real estate market that was bubbled and overblown. You have youth unemployment in that country that's 17%. And that really portends to much more structural challenges where the youth coming into the economy can't find employment because the economy is set up for a different type of economy and where their skills sets are and whatnot. That's going to create huge challenges it already has when you have a 17% youth unemployment. The broader employment in China is 5%, so closer to this country. But keep an eye on that one because that's going to be a challenging stat. And then finally, a shrinking population, which is never good for any country, but it's particularly aggressive in China. And I think all those factors pertain to it, sort of domestic challenges for China, which will limit to some extent how aggressively they can be on the broader world stage. So those are kind of some of our macro barometers we're watching. And then we're going to switch to sort of what we're seeing in the M&A market. And then we'll talk a little bit about the debt and kind of come back and try to put a bow on all this. But, from a kind of deal activity, as we talked about, strong Q3 at Progress. I think generally around the market, we're seeing conditions improve. It's been a stable market, as you saw in my opening piece on the GDP, and just that we always say the bid-ask spread has kind of come closer together in terms of pricing in the private market. The public market's been at a high number of record highs over this year, but especially recently. The interest rates continue to come down. I will say the 10-year Treasury has increased about 0.75 of a point over the last few months. That's part of, I think, the challenge of the new administration and some of the concerns about potentially renewed inflation. But generally, we're in a stable, almost Goldilocks type environment for where you just want to see all these economic indicators. We're going to talk about deployment pressure, but that's a huge factor for all these private funds, venture capital, growth equity, PE. They've got a ton of capital they have to deploy, and they largely sat on the sidelines for a lot of 2023 and the first half of this year. The debt markets, which were challenged back in 23 with the Silicon Valley Bank and First Republic and that crisis, long gone in history, came back strong, and a really growth of private credit funds. They continue to be a real lubricant for deals that need debt. Obviously, a higher cost than it was a couple of years ago, but in the context of a broader time frame, not too bad.
And declining rates.
And declining rates, correct. And then, the IPO market, which we'll talk about in a little bit, it's definitely it's open, and generally IPOs have been performing well, and that's a good sign for future IPOs.
This right here is a high-level view of total M&A globally on an annual basis. As you can see from some of the trends, we are down from all-time highs that we saw in 2021 and the first half of 2022. But where we're really tracking is back to pre-pandemic norms. The 2024 chart here is a view of the activity through the first half of the year. Things from our perspective are tracking, again, kind of in line with where they would be for 2019 and 2020. One of the trends that we have been tracking here is the pullback in private equity activity. You see that represented by the yellow lines here. That, again, has been driven by some of the factors like increased costs of leverage and some difficulties with bid-ask spreads and deals, but things are starting to get done.
Yeah, I would just say that private equity, again, as a percentage of total deal volume, has pulled back the last few years, but before that, i.e. before 2020, it was on the increase, and I would look for that to continue. Back to my previous points, they have so much funding, they have to so much dry capital they have to deploy, and as the kind of cost of leverage, which has been a big part of a lot of their math decreases. This is so the previous was sort of broader M&A, corporates and financials. This is just U.S. private equity deals on the left, and then exits on the right. And you can really just see how robust that sort of 21, 22 period was. And to Brett's point, we're sort of back to more of a normalized period. But we are seeing, you can see it really on that uptick in the last this is quarterly, as opposed to the previous page was annual. You can see that uptick we're talking about in this year, kind of quarter over quarter, as the credit markets improve, as the IPO markets improve, and we're just seeing increased liquidity for these funds.
A lot of the trends from PE are mirrored in VC, although the slowdown might be a little bit more pronounced in venture capital. I think that this is driven by a few big reasons more recently. One, there's been slower fundraising at VC funds, so there is a bit less capital to be put to work by traditional funds. A lot of people in the venture community are still dealing with a lot of high valuations that were set back in 2021 and 2020. Those are still being worked through. And then the third large factor is the pullback from your non-traditional investors. A lot of the activity during the peak of the market was done by crossover investors, hedge funds, corporates who traditionally weren't in the venture capital ecosystem. I think a lot of the positive trends around M&A should help revamp this in the coming years. And, if you look at the two charts here at the bottom, take a step back, you can kind of see how a lot of the trends that we're now seeing this year mirror, again, what was reflected pre-pandemic. On the exit side, it's important to know how much of an anomaly the IPO market was in 2021. Over 85% of the exit value that was generated that year was from the IPO markets. So as those begin to reopen, I think it'll help free up a lot of liquidity for the VC system.
Yeah, and it was a lot of SPAC activity mixed in. That has
Definitely plenty.
On the fundraising side, we've kind of already touched on it. Fundraising for venture funds and private equity, doesn't look so bad. Probably less bad on the private equity side than on the venture capital side. But there's investors in funds want to see capital back before they commit to new funds, and so we've seen a big shift towards larger funds, well-known funds on the private equity side, and on the on the venture side, it just has been more difficult across the board, and we expect that to continue until there's meaningful liquidity of all those those older funds. This is a cash flow chart. If you are an investor in private funds, you have been a net investor for many years. You have put out more money through capital calls than you have gotten back, and we need that to turn positive, and we expect that to happen in the coming years in order for people to make new commitments. So we watch this closely, but it's a challenge. It's happened before, and it will happen again. This is a very kind of lumpy market that has peaks and deep valleys. So. This is just on the just to give you a little bit more perspective on on the existing NAV that is out there, meaning capital that has been invested by private funds. There's a lot of NAV that is now over 7 years old, that is well beyond the underwriting of those deals. So the returns, even if they're positive, are going to have disappointing IRRs. And it needs to it needs to be worked through, and as the bid-ask spread is narrowing, as people are becoming more realistic about valuations, these companies will start coming out, and the system will be rebalanced.
Just quickly on IPOs, I used to be a full-time IPO banker. It's really simple. Look at the green at the bottom of each of these logos. That's the stock price performance since the IPO. I always say look at it for the first 30 days of trading, and also look 6 months later after the lockups expire on the insiders. That's when there's often selling pressure. You hear terms like overhang. Everything on the left has gone through its first month and it's 6 months, and it's trading very healthy. That's a good sign for future IPOs. And on the right, some of them haven't quite crossed their 6-month lockup date yet, but they're performing well. If they continue to perform well, and the market performs well, there's going to be more IPOs. And then you can see some of them at the bottom here, some of which those companies we know quite well. Finally, I've talked about this before, but this is sort of graphical representation of just how much dry powder there is. Back to the previous pages that Brett and I went through about, VC exits and deals generally. And Adrian was talking about when there's exits, they raise new funds. There hasn't been as many exits, but there were a ton 2 or 3 years ago. They went out and raised records amount of capital in 2021, and they're sitting on that capital because I said earlier on, they didn't deploy it that aggressively in 2023. And so they have to deploy it. They have a 5-year period if it's a 10-year fund, and they feel that pressure. We can hear it.
Yeah, and it's always been an issue coming out of cycles, but this time around it's so significant.
Correct.
That it is likely, or it is distorting the overall deal market, right? If you don't use this within the 5 years of the investment period of these funds, you lose it, and people don't want to see it because they paid fees on it. So it's really becoming a factor, and with kind of a $1 trillion sitting out there, it can really distort the market, and so we see it as a positive sign towards driving deals. But there's going to be a lot of pressure and a lot of competition to get things done, and we see it for some of our companies. When we hear about processes where people see 20, 30 LOIs for attractive companies, And then we're going to see more of that next year. It's good for our venture portfolio as our companies grow up, but bad if you're looking to deploy a fund.
Okay, so we're going to talk briefly about the debt market, and then we're going to come back and sort of wrap it up in our views of sort of the current administration and the market going forward.
Yeah, just quickly some observations from loan activity. First, we're seeing a lot of positive trends. On the left, you can see that the leverage loan default rate has actually been decreasing in the past few months. At this time last year, they were starting to go up and spike, and people were wondering how long is that spike going to last for. And what we found is that it's quite contained and well below historical norms, and where even a lot of analysts predicted we would be at this point. This trend is also mirrored in the commercial real estate sector on the right. So we haven't quite seen a systemic risk yet. I think largely lenders had a thesis that there was going to be a recession at this point, and because of that, really tightened a lot of their credit standards over the past 2 years. And you're seeing that now. A lot of the companies that did take on debt are quality and have been able to manage it quite well. Another positive signal that we're seeing out there is the spreads. So spreads on loans represent the premium between the total yield on a loan and the benchmark rate, so something like LIBOR or SOFR. And what we're seeing is that spreads have been decreasing. This kind of has a couple of factors driving it. One is the increased activity and competition between lenders. There's a lot of potential sources for capital out there. But also I think it's generally a positive signal from the lending market that there is confidence in what they're lending against. Lastly, we'll look at loans in terms of the private equity market. As you can see in the top left, the increase in valuations that we've started to see this year has been driven by more debt being put into deals. If you look in the bottom left, debt is still at a relatively low level compared to what we've seen over the past decade, but it's good that these private equity firms are able to put more leverage onto their deals. If you look over to the right, you're kind of looking at, again, some of the spread activity on these loans. The spreads have been decreasing, and that's been pretty consistent for a couple of years now. That signals further confidence in private equity's ability to manage a lot of this. So we, again, see this as really a positive signal for potential for future M&A activity.
So let us now turn to US policy, given that the election is behind us. We think the key, if not the main topic this next year, will be the federal budget and taxation and spending. This is just a visual for you to show what the revenues are of the United States and what the United States spends. And as you can see, we spent about 2 trillion more than we take in. And the US has had the great privilege of being able to do that as one of the only countries in the world that can do that. But you can only do that for so long. And we need to bring this in balance. And we think next year, this will be the key focus because the tax cuts that were agreed to in the prior Trump administration will sunset at the end of next year. And so unless something is done, we will automatically get a major tax increase starting in 2026. That is something neither Democrats or Republicans want to see. They have different opinions on where they would like it to be, but it will require compromise and discussion because you can either increase revenues or decrease spending, but neither of those are popular politically. So you have to do it together. And given the tax cut expiration, we even think even with Republicans controlling both the House and the Senate, it will require compromise. And the ultimate bill, we do think there will be a continued tax cut, but not as big as what there was. So part of this deficit will start coming down next year, but additional things will need to be done. And so let's look at where we are today. Next page. Here on the left is US debt as a percentage of GDP. And despite what everybody may have perceived or thought, until the COVID, the US really was not that indebted of a country, and it was well below 100% of GDP. It was very manageable. Debt is debt, but we were not, one of these, systemically high indebted countries. That has changed. That has changed over the last 3 to 4 years. We are now over 100%. Actually, we came down a little bit the last couple of years because the growth offset the debt increases a little bit. But where we are today, as net interest starts to become a very big expenditure in the outlays of the government, this is scheduled to continue to grow unless we do something. And at some point, the markets will speak and not allow us to do that. And when that will be, or how close we are to that, is not clear, but it will all of a sudden happen. And so having this debate next year and starting to address this issue is, from our perspective, really important. So let's talk to the tax side of things. Where can you get it? And where does the US get its tax revenue? And I think it's quite enlightening to kind of look at that, and then where can you get more tax revenue if you are going to go that direction? And we personally think we need to go there to a certain extent. Half of tax revenue is individual income tax, and then a good third is payroll tax. Actual corporate tax, which we talk about, is not that significant. So moving that up down or up a little, doesn't really move things. You really have to focus on personal income tax. And I hate to say it, but I think we will be looking at increases, across the board. And the question will be, who will pay it? So let's look at that a little bit. And again, we took a lot of this from the Peterson Institute, which has pretty conservative stance on saying we need to go fix this. But I think they've made some great slides on this. Just actually go back to one slide. Just on the right-hand side, just quickly looking at, what is the effective tax rate for across the board? And as you can see, it's not surprising, the wealthier or the higher incomes are paying more, but it kind of peaks out, depending on how you calculate it, in the 30% range. And the lower income, percentage of population pays, not that significant of a percentage. So how does that translate into actual tax revenue? Can I explain? Here you can see that the top quartile of in the US generates about half of the income and pays about 2/3 of the tax. Again, if you're gonna collect more income tax, right, you really have to reach into that, what I would say, top quarter, top half to make significant headway. So the tax, I think, will continue to be progressive. And you will see these numbers shift even more if we are going to generate more tax revenue. And again, I think that's where we will automatically be heading based on how things look today. And just a quick visualization of what the impact is of the original Trump tax cuts and what would happen if no compromise is reached. And you can particularly see on the right-hand side, if you extend it altogether, right, deficits will grow very significantly. If you take it away, right, you're looking at about a $1.8 trillion increase in taxation. So something will get done next year. It will require compromise. I think it even requires compromise within the parties that control the House and the Senate. And I think it's going to be a good debate for the country. So
okay, yeah. So in the final 5 or 10 minutes, let me talk about sort of the election, and I'll say at a high level, we're going to know a lot more in the next few weeks about who's in charge. I know he's put up a lot of names. Not all will get through. And then there's a question in the chat already about if the incoming administration actually delivers on proposals they have floated, what could be the impact on the economy, on M&A and global relationships? Not good. If they're done in full. Just take 3: tariffs, high tariffs. That raises the cost of everything. Lower taxes puts money in the system, and as Adrian just said, has a whole bunch of structural issues in terms of how this country can withstand a lower tax base, and then expelling all immigrants. We need them. We have 4.1% unemployment. They're a vital part of our economy. So if there's some sort of surfacey stuff done on all three of those, that's okay. If they become much more structural and significant, that's not okay. So just quickly, we talked about this before. Certainly that was a nice positive surprise and good, the transition of power. As I said, it will become much clearer in the next couple of weeks and months. Is it ideology or smart, pragmatic people? Seems to be more ideology so far, but we'll see how it comes through and what actually happens. As Adrian just said, tax policy is key, as those expire in 2026. And I said this earlier on, you've seen this already in the 10-year Treasury, which has risen, even though rates are going down. So you wouldn't intuitively expect that. It's risen actually 0.75 of a point. It's currently 4 3/8 because of this risk of inflation potentially coming back as a result of everything I just mentioned. If you lower taxes and increase tariffs, you're going to get inflation. Immigration, as I said in my comment a minute ago, you need immigrants in this economy as we're set up right now, and that's not going to change anytime soon. Definitely diverging, almost irregardless, I said, of kind of Trump, but that only accelerates it in terms of U.S. and Europe, and in terms of our interests with NATO and otherwise. And as I said earlier on, China, with its challenged domestic economy. And remember, China is still only 2/3 the size of the economy of the U.S. Russia's 1/10 size of the U.S. As I said earlier on, the Middle East seems to be keeping everything contained for now. So increasing deglobalization and increasing the challenge in each of these regions, but they're largely sort of staying intact for now. As Adrian alluded to earlier on, the dollar as a sort of safe currency and the U.S. as a safe haven could come under additional pressure with additional debt. And as I alluded to earlier on, increasing dysfunction in this government, which certainly has a potential chaos and dysfunction. And that's why, I think a few weeks ago, we were only really talking about a base case, which we felt quite good about. We still feel good about it. This is a good lead into our next page. But there are other scenarios if any of these factors I just mentioned now get a little more out of control. That's a good lead into this.
So this is our kind of our key slide for next year. Kind of going back to the first page. Where do we expect to go next year? And our base case at this point remains very much what I would say continuation of what we saw this year. We expect 2 to 3% GDP growth. We expect stable employment, and we expect the Fed to steadily keep decreasing rates to 3.5% and then kind of hold while inflation is in that 2 to 3% range. And what does that imply from a policy perspective? We expect a tax policy compromise or solution that will be broadly acceptable. And we don't expect a significant impact from tariffs to realize this base case. Next to it, we have two other scenarios that we really didn't see this year, but that have a higher probability. The first one being, and probably the more likely of the two, is that the economy overheats. If we really, cut taxes further, fully extend the tax cuts, perhaps even more, if GDP accelerates beyond the 3% that we have been seeing through what I would call organic, reasons, meaning just increased productivity, people feeling better, and assets, asset values keep popping up, going into bubble range, we're going to start seeing inflation return. There's a chance that will happen, and I think we will see that, and I think the Fed will react. The Fed will not cut rates to 3.5%. They may even signal increases. I don't think we're there right now, but I think we could get there. And then what I would say in the more extreme case, if we do have a very significant disruption of the labor market, very large deportations, we have very significant tariffs, and the market becomes spooked by all of this, and freeze up, and borrowing costs go up. We could see a scenario where the growth stalls, and we get that hard landing that we had been worried about all of this year, but we didn't get. Yeah. And then the Fed really has to interfere, and yeah, there are different things they will do, but that would be kind of a worst case scenario. We don't see that happening right now, but we could. And again, we will know a lot more about where we're heading at the end, by the end of Q1. The new administration's policy will be clear. The economy will be clearer, and I think we will have a much clearer scenario whether we are in this status quo scenario or heading to one of these other ones, and we will adjust our guidance accordingly at that point.
Yeah, and to some extent, it's the hawks and the people a little more based in reality in the Republican Party that will keep that group hopefully in check.
Yeah,
and we'll see how that plays out.
Yeah, and then just this slide is kind of more our long-term outlook. Assuming we have a stable next year, this very much remains our view of the world, that we are at the beginning of a very nice, solid, 3 to 5 years, driven by innovation, driven by growth. That given the chance, given a stable underlying foundation, we think is really realistic, and it will look more like the late 90s, or a repeat of the late 90s, but then in this case driven primarily by AI. And so we call it a new economic cycle, and we really hope that that's where we end up, and that's where pragmatic decision makers will lead us.
So I think there's another question about our assumption. Assumes the market doesn't think Trump will do what he says. That's correct. Not to the degree. It's all about degrees. I mean, I think there's some incremental catches headline moves, and there's sort of substance of it. And I think that's where our diversion of the views lies, and we think it will be in the base case for now. We've summarized all this, but just say at a high level, the economy is in a Goldilocks spot. 2% inflation, 4% unemployment, 2 to 3% GDP growth, has been for a while. As Adrian said in the opening comments, I think people are sort of coming to grips with that reality. I know inflation was a big shock and a few other things, but the key metrics are really strong. The Fed has actually been quite strong and brilliant in how it orchestrated this landing. There was no negative economic growth. Public markets are at all-time high. I think the private markets have been slower, but they are catching up, and we're seeing that in deal activity. We'll get a lot more clarity on the where this administration is going over the next quarter, so stay tuned on that. But we really do believe this multi-year cycle, and we think that's sort of the status quo base case. Geopolitics are in check. As I said, there's potential black swans on all fronts, but to date, it has been a containable risk, and we believe that will be the case for the foreseeable future. And stay tuned. We'll do another one of these, and we'll know a lot more in a few more months.
Mid-February.
Yeah. That's it. It's exactly an hour, and
We have room for a question.
Yes, we have one more question. It's what incremental signals would you be watching in the next few months to suggest unlocking of dry powder / movement in the private market?
Could you repeat that?
What incremental signals would you be watching in the next few months to suggest unlocking of dry powder or movement in the private market?
I think the key to that is the further reductions in the cost of the interest rates and borrowing overall, because most of that is sitting on the private equity side. Most of that is dependent on leverage, and to make it work, the cost of debt needs to go down, and the availability needs to increase. We think the availability is there. It's just the cost is still too high. Although that's starting to change, and I think the turning of the cycle where we actually started decreasing rates was key to starting that, and that's why I think we've seen the activity here in the fall, because that means people are expecting it to continue to fall, and as a result are willing to underwrite to a environment where things.
And I would just say I think we're seeing those signals already. I mean, as I said many times, we've seen a strong Q3 and Q4. I think 2025 will be stronger for every reason I just mentioned, but we're seeing that at real time.
Yeah, and of course exits and IPOs, right? Freeing up capital, and getting that redeployed.
Excellent. Thank you, guys. Thank you all for attending. If at any point anyone wants to discuss any of these topics further, please feel free to reach out to us. And we will see you next quarter for another one of these.
Thank you.